All right, now, are you someone that feels like you can't invest because you don't have enough money? Well, it turns out a lot of people feel this way, including high income earners, with new research from investment platform Stake revealing half of non investors cite lack of funds as the reason for not investing, a mindset that is prevalent among 30% of high income earners. So, is it a legitimate excuse or does it reflect a lack of ambition? Well, for this week's Dollar Dialogue, we're going to be diving into this research with Stake's Chief Customer Officer, Bryan Wilmot. G'day, Bryan. Welcome to the Savings Tip Jar.
G'day, Dominic and Harrison. Thank you so much for having me.
Thanks for jumping on. So before we get into all this research coming through, do you have a savings tip for us?
Sure, I do. I don't know if it's going to be revolutionary, but it is a handy one. Nespresso. So coffee prices, I'm sure everyone is very familiar with the absolute spiking of those. But double espresso on my way into work cost me about $1.60. So you're saving about, I don't know, $4, $4.50 every day, every week, every year, compounds over time. So that's a pretty handy one.
Nice one. Yeah, as a coffee drinker myself, that I definitely subscribe to
Maybe
that
put
way of
that in
thinking.
your Stake account.
Indeed. So, yeah, Bryan, just getting into this research, just straight off the top, that, excuse a lot of people are using that they don't have enough funds. As I alluded to in that intro, is that a legit excuse or does that reflect a lack of ambition?
Look, I'm sure for some people that is a legitimate excuse. So don't want to sort of degrade anyone's sense that maybe they don't actually at the point in time in a cost of living crisis have money to go and invest. But what was interesting is that response as the top response is a reason to not invest by the half of Australians that don't invest outside of their super. Pretty flat across income brackets. So even people earning over 201k, as you said, are still sort of citing that as the top reason. And look, they may have expenses and it may also, again, be a legitimate reason. But at that point, you sort of think there is a capability perhaps to put things toward investing. We do see a lot of people still put things towards savings. And so the sense, that we're getting from our customers and from Australians at large through this report is that it's more of this confidence barrier, it's this emotional barrier, it's this fear of loss or loss aversion that is the reason that's not driving them into the market. And the more functional, I don't have enough money reasons are possibly very top of mind conscious excuses.
Yeah, for sure. Now, amongst friends and family, there seems to still be this kind of notion that shares are just inherently risky, and a lot of sort of older generations will tell younger generations at family barbecues and things like that, don't bother with the share market, even though it's easy as nowadays to learn, and say pile that money into property. Is that something that kind of shows through in this research a little bit?
Yeah, it certainly shows through in the research in terms of this idea of loss aversion or needing to have a certain level of confidence to start investing, or the perception that you need to have a certain level of sophistication or knowledge to start investing. And that's something also, I've been with Stake for 6 years and pretty much since I've joined, I've heard that, from people at large, when I've called people up on the phone or spoken to people at events, that there is this sense that the stock market, culturally is perceived to be more risky. I think it comes down to it's certainly a little bit more complicated. Like the idea of property investment is something that you're kind of just intuitively you absorb as a kid growing up. The idea of you've purchased something physical and it goes up in price over time is one element to it. And the other element to it is that you're not really looking at a value of your property on a daily basis. Whereas then on Stake, you can go and check your portfolio every day. It's going up, it's going down. You're sort of seeing and experiencing that volatility, which can create a lot of emotional panic when you put savings or money into the market and you're trying to build or put your money to work over the long term, and you start to see it dip for a couple of weeks. That can create fear. But it's really about understanding that emotion is natural and to sort of push through the fear. And if you look sort of macro at how the stock market has performed, obviously individual stocks go up, they go down. The market as a whole goes up and goes down. But if you just look at the trajectory of the past 100 years, the stock market, I think, has actually outperformed the property market. Don't quote me on that 100%, but it certainly is just this continued growth despite these peaks and troughs through that journey.
Now, Bryan, looking through this report, one thing that jumped out at me was the concept of inheritocracy, which I can't say I've heard that term before. Can you explain this a little bit, and also its impact on mindsets?
Yeah, so I think really what it's born out of is this shift in the belief that your core career and the salary that you earn is really just not enough today to keep up, let alone get ahead. So the idea of that your salary itself is going to be enough that you can put things away and put a deposit down pretty early in life is sort of a tale of generations bygone. And so what we're sort of seeing is that people are realizing that these other mechanics in the economy that they need to be a part of to supplement their sort of core salaries if they're going to be able to get ahead. In previous reports, the idea of asset ownership has come through as one of those mechanics that I need to start accumulating assets in the way that I can earlier in life, rather than just focusing on my salary. And now it's this idea as sort of obviously the boomer generation, which is the wealthiest generation sort of we've ever had, is starting to get toward those, later years, the sort of windfall, inverted commas, that, millennials, Gen X, Gen Z might be sort of looking to inherit. People are sort of seeing that as like, well, that's the big ticket potentially versus this career that I'm building where I'm really not going to be able to get into the property market, with the salary that I'm earning over the next 10, 15 years. So it's more of a perceptional thing. It's more of a how people are thinking, how am I actually going to get ahead when I'm sort of feeling like I'm falling behind despite, working really hard. And this idea of if my parents doing something or if, there is something waiting for me in 10, 15 years time, just that perceptional thing that's actually going to be the needle mover.
Yeah, for sure. Like at least, like it can feel like you're treading water with a savings account or term deposit when, if you're lucky to return 4% and, inflation's at 3%, you're not really earning much over in real terms.
Exactly.
I'll just list off some stats here. So the research said half of Gen Z, 55%, and then nearly half of millennials, 49%, now believe what you inherit is more important than how hard you work. Contrast that with less than 1 in 5 baby boomers. So I guess the proofs and the stats there. Speaking of, like, if you're getting started with your investment journey, where do you go to for advice? There's some stats here that suggest that younger people are more looking at, friends rather than family. And then off the back of that too, you kind of briefly mentioned AI. How's AI kind of playing into this space?
Yeah, so look, family and friends is always, I think, across categories. It's not even just when it comes to the stock market. When you're uncertain about something, even if you're deciding what dentist to go to, you might ask family and friends who they go to. It comes with a certain level of inherent trust, that you trust the people that you know and the things that they do. So family and friends is always going to be a prevailing resource, inverted commas, for people. But we are seeing sort of over the past, as I said, 6 years that I've been with Stake, social media, online content creators that are really giving, there's the spivvy end of that, but there's, guys like yourselves, which are giving good advice around finances and financial investment and opportunities. And so the, younger generations, not just 20-year-olds, but, under 45, sort of millennials stretch up that way, are looking to those alternate sources, really to just start understanding some of the simple foundational elements to begin their journey. And if they are a little bit more sophisticated already, there is also a lot of content out there that you can continue to grow and learn and develop. AI has really just become this layer that sits on top of that we're seeing customers, investors start to use to sort of just filter things down, like the same way you might be wanting to know what a good restaurant in Rome is if you're going over there and you're going to use ChatGPT instead of Google search is sort of the shift in behavior we're seeing. It's the same sort of thing. Instead of going and wading through what is a lot of information on the internet, people are just starting to use AI to sort of shortcut and get the really prompt and sort of accurate responses to the particular thing that they may be looking for in whatever it may be.
Yeah, AI is just really taken over, isn't it? Just keep hearing about it more and more, and keep fearing for our jobs. But I haven't heard too many AI podcasts yet, so we might still be going strong for a while yet. Just finally,
your podcast name, and you'll be fine.
Okay, right. We'll make sure we do that. Just finally, this concept of investing EQ. Can you explain that a little bit, and also the importance of it to investing?
Sure. So it's kind of the idea that, investing, and again, lots of humans are humans. So it's true with lots of things in life, but certainly what we see with investing coming out of this report is that there's the functional or the rational elements. There's I've got this much money and I'm doing some research on this stock and I maybe think it's going to go up over time and I'm trying to put my money to work. But there's also the sense of security. There's also the sense of optimism about my future. There's also the sense of safety and financial stress that I'm looking to overcome by building habits that may generate, grow my wealth over time. So what we're seeing is really interesting is that basically in this report, we identified that half of Aussies are basically investing outside of their super and half aren't. And for the half that are, again, across ages, across income brackets, whatever sort of way you want to cut the data, those that are investing outside of their super are reporting higher levels of optimism, are reporting high levels of being satisfied with their financial situations, despite, and again, it's across income brackets, so it's not that people who are investing are genuinely or definitely more wealthy than those that aren't, is that the act of getting started, the act of taking a little bit of control, not just delivers that, that rational growth of your portfolio, but it delivers these emotional benefits of, I'm doing something and the challenges that I might be experiencing in the real world suddenly don't feel quite as big because I'm actually on a path to overcome those challenges.
For sure. Now, just quickly, Brian, we'll get your take on the markets. That can mean anything from like the Nasdaq to more homegrown, like the ASX 200. What's your take on it? Because a lot are at sort of like record highs at the minute. Is this bubble territory? Are there still legs to grow? Like, what's your general broad take on it?
Look, certainly won't forecast. I think no one has a crystal ball, and certainly not myself. Where I'm not a investment wizard. I'm the chief customer officer. I exist more on the sort of customer experience and marketing side. But I have been with the business for 6 years, so I've sort of been around lots of intelligent people that do know lots. But look, I think in the markets generally, what we've seen this year in terms of sort of the highs that have been hit across the board. Obviously, interest rates have been coming down. We've seen that consistently in Australia. The last one in the US was in September. I think they dropped 0.25%. Obviously, optimism around AI and how that's just going to transform industries across the board. It's not just these companies like NVIDIA that are part of sort of the development of the AI technology itself, but it's also just everything is going to benefit from this sort of horizontal layer and the impact that we're going to see from AI. Companies have been reporting strong earnings, so the actual numbers have been positive. So it's not just necessarily in all aspects high speculation, but we've actually seen really positive results. Even today, a number of companies reported, I think only Netflix out of the 6 that we took a look at sort of just slightly missed its earnings, with the other ones beating the expectations. You've got maybe a slight easing of the geopolitical tensions, possibly China and US getting to a bit of an agreement there, possibly some of the wars, hopefully drawing to conclusions. So lots of different factors. But what's been really interesting for us is actually the resilience of retail. So what we've actually seen is over the past, again, sort of 5 years, most profoundly or most noticeably this year, we've seen that when things have started to taper off and things have started to drop a little bit, typically retail panics and retail starts to sell down, and sort of wholesale institutions sort of bets against that. But what we've seen is, and again, it's just the maturity of retail that has grown out of what has become a mainstream behavior to invest, is that they're much more resilient. They're not panicking as much, and they're actually buying the dip, if anything. So that idea of investor EQ that we spoke about, that when you do see red in your portfolio, people are seemingly able to keep a cooler head and either maintain their positions or in some respects, top up and take advantage of the things that they're seeing. And that sort of flattened out, I guess, those big dips as well, and has created the capital still coming into the market even in those moments. So lots of different factors. The markets are a crazy, chaotic beast, but those might be a few.
Certainly, yeah. What I can say is 2025 was and still is very interesting. Me personally, I've been on the sidelines a bit this year because I pulled out all my entire share portfolio and my savings to buy a house. So I've been watching on the sidelines with a bit of jealousy, although I was feeling pretty smart when I withdrew before the that sort of February earlier in the year dip. So much more to come so far in 2025. The markets never really sleep. Bryan Wilmot, thanks so much for joining us on the Savings Tip Jar podcast.
Pleasure. Great chat. Thank you for having me.